Hope you had all a great new year. This is Steve Nison, and what we're going to do is, because it is the start of a new year, for our market update, I'm going to do a longer term market outlook. And keep in mind that candlesticks can be used in all time frames, and that includes not only intraday and daily, but weekly and even monthly charts. And I personally use candlestick charting with Western technical analysis for my own retirement portfolio, and you can do the same as well. So let's look at some key markets. Okay, first we'll start with the S&P. Here's a weekly chart. Amazing, isn't it? And here's a monthly chart. And even with the big sell-off we had a few months ago, when you look at a long-term chart like this to kind of keep things in perspective about the long-term bull trend that we're in, and just to show you on the monthly chart, nice bull channel. Very much in place. And so from a longer term perspective, I would use this bull channel to define support. Okay, right now it looks like around, it's much lower than current levels only because this is a long-term channel, but this is a support area. And although the rising resistance line is resistance, it's still higher and higher levels. So as time progresses, this will be increasing. And for those of you who've been following my comments, since the breakout that this market had back in, and let me draw a resistance line here. Okay, when the market broke out in mid-2003, when it was 1530, I had projected a 50% rally to anywhere from 2200 to 2300. And it looks like that, we're getting closer and closer to my target. And actually, as I mentioned, I use these strategies for my own portfolio, and I got more into stocks, into the equity portfolio, into the equity portion once the market broke out, with the idea that this old resistance should become new support. And interestingly, let me just expand this. Notice how once the market closed above it, okay, when it pulled back, it held this area as a support level, almost to the tick. So there's always a price that says we're wrong, and my price that would have said I was wrong on this breakout would be, in other words, getting a target at 2300 would have been if the market closed, at least on a weekly basis, under the 1500 level, and it did not. So, my longer-term outlook remained intact. And how I got that target, and it's still my target. Now, keep in mind, a target doesn't mean a resistance area. So what I'm going to be doing, and what you should be doing as well, is keeping an eye on the candlestick signals to see if there's any bearish candlestick signals as we get to a target. So essentially, the way I got the target is took the top end of the trading range, okay, and that's right around the 1550 area, 1550 area. And conservatively, I use this. See, this is a box range, and you could either use this at the bottom of the box range or that. So I was more conservative, and I was using this as the bottom end of the box range, and the lows there were right around the 770 level. And even over here, which is, a little higher. So essentially, give or take, it's anywhere from really 700 to 800 points added to the kind of rounding off again, the 1500 area, and it gives you a target to 22 or 2300. And if you use this as the bottom end of the box range, you have to add another 100 points, and that could be 2400. So, it's still my target. My minimum target is 2200. And it's actually a zone. I would say 2200 to 2500 as a longer-term target. Here we have in the weekly chart no bearish candlestick signals. The issue is, and it really has been for the past few months, is from a risk-reward perspective, you really can't do anything here. Remember, with the target of, even if it's 2500, all right, my outside target, if you're buying here, the risk is, your potential profit is 400 points, but your risk is all the way down here. All right, because this is the key support area. This is the price that would have said I was wrong, and we're well above that now. So for those who currently have longer term investments, once again, I'm still looking 22 to 2200 to 2300 as more or less a conservative target, and I would suggest keeping an eye on the candlestick signals to see if there's any reversal indicators on the weekly charts. The daily charts I wouldn't be too concerned about because it's a longer term outlook. Now also, speaking of keep an eye on the candlestick signals, and keeping an eye on keep an eye on your emails next week. It's going to be one of the very few times we offer our mega package, and the mega package is our most detailed and advanced analysis, candlestick education. It goes over strict criteria. It goes over the psychology of each pattern. It shows you how to use my favorite candlestick signal and all the what we call secret Nison nuances of each candlestick signal. So be sure to keep an eye out on that in your emails for next week. Okay. Okay. Now let's look at crude oil as it's free fall, and there's excellent support in crude oil at 0. That's one of my jokes at my seminars. I'd ask the audience where is key support in a market like this, and they come up with different numbers, and I say 0. But anyway, let's look at where the target is. This is a weekly chart, and let's look at a monthly chart. And by the way, this is how I would spell weekly for the weekly chart. So let me get rid of that. So let's look at a monthly chart. Okay, and here we can see on the monthly chart that we've exceeded the support area, okay, by a little bit. This low over here. This to me is really minor support. My target actually in crude would be the lows that we made back in 2009, made with a beautiful hammer. This is let me make this a little bigger here. Okay, this is a strict criteria, almost a strict criteria hammer. The perfect strict criteria hammer would be a white real body with no upper shadow. Again, the strict criteria information candlesticks are in that mega package I alluded to before. But essentially, it's more likely that candle signal will work if it's a strict criteria. We can have a black real body with a hammer also, but a black real body means it doesn't close at the highs. A strict criteria hammer would be a white real body that actually closed at the high with a very long lower shadow. So not quite a strict criteria hammer, but very close. Anyway, so this would be my target, the lows of 2009, and that would put potentially down around the $42 level. And if for some reason crude does have a rally, my key resistance area would be the prior support, 76 in that area. And assuming the market does rally from here, although there's no bullish candlestick signals, the 38% retracement would also be around that $75, $77 level. So another reason for resistance on any major rallies in that zone over here. And for you Forex traders out there, let's look at the key currency, Euro US, and a weekly chart, no bullish candlestick signals as we continue. It looks kind of like the crude oil market, doesn't it? In kind of a free fall. But we are closer to a support level in the euro than we are in crude oil. And let me show you a long-term weekly chart here. And we can see this classic bullish engulfing pattern. And I'm just going to expand it here. And this all, by the way, this is a strict criteria bullish engulfing pattern because the white part of the real body wraps around not only the black real body, but also wraps around the shadows. So that's a more powerful signal than just the classic basic bullish engulfing pattern. Anyway, that's my target here, bullish engulfing pattern as support. And the euro is not far from there. The lows here were at around 120.40. So keep an eye on potential bullish reversal signals there. And let's see on the monthly chart, give you a sense of why, as we get to that level, it's so important. So here's the lows that I was just referring to, a little above the 120 level. This is a monthly chart now. And notice this classic morning star over here and a bullish engulfing pattern here. Look at the size of that white real body compared to the black real body. Long upper and lower shadow. There's a high wave candle showing us the market's confused. In other words, the bearish momentum might be losing steam. So while key support is here from the lows of 2012, even if it breaks under there, I'm not looking for much more on the downside before major support steps in right around the 119 level. So if you wanted key long-term support on the euro versus the dollar, it would be right around 119 to around the 120 level. And interestingly, it's kind of in 200 pip steps. See, under the 118 level, you have another key support. So I know it's 400 pips here. We're looking at different support zones. So what I would say is if it does break under 120, remember this is a long-term chart, then the next target would be 118. And if it breaks under 118, my target would be 116. But these are key long-term support levels.